Hi, so what we're going to actually cover first is really important. We're going to cover the differences between retail traders and professional traders. But we're going to start at Professional Traders 101, which is essentially defining what a professional trader actually is and what a successful professional trader actually does. Now, this is really important and you should not underestimate it, simply because from a professional trader's perspective, I can tell you uncategorically that retail traders totally misinterpret and misunderstand what professional traders do. Now, this leads to a big problem because essentially retail traders, their objectives are really to emulate what successful traders do, but do it with their own money. Now, it's a problem because it leads to retail traders to make many mistakes and go down the wrong path of trading. Now, once you understand what a professional trader actually is and what a successful professional trader does, then you can begin to emulate with your own money what a professional trader does. So we're going to go over to the stage now, and I want you to really focus on your objectives here. Your objective as a retail trader is to make money using your own money, and in the process to emulate successful professional traders. Therefore, we're going to start by defining exactly what a professional trader is. Then we'll move on in the next section to what successful professional traders do. Let's go over to the stage and I'll see you on the other side. So the first part we're going to do is actually define what professional traders do. Question one, what does a guy in an investment bank do, a professional trader? What does a guy at a hedge fund do? They're quite different functions, quite different roles. What does it mean for the retail trader who's trying to emulate them? And the differences between professional traders and retail traders. So professional traders at investment banks, 90% of a trader's time at an investment bank is actually spent being a market maker. And only 10% of their time is actually spent trading the bank's money and using that money in an attempt to make a profit. So when you look on CNBC, Bloomberg, on the television, and you see the trading floors with all the guys walking around and lots of screens at their desks, what are they actually doing? Well, 90% of the time, they're just making prices in the market to clients. So is that what we do as retail traders? Who says yes? But it's clearly not. We don't have any clients. We don't care. The objective here, like this gentleman already outlined, is to just make money. Using our own money to make money. We've got no interest in market making. But let's have a look at the business, how it actually works. The market making business is literally the bread and butter of the bank. And it's split into two categories, really. It's an agency business and a risk business, okay? What do we mean by an agency business? You're not on risk to the client. So the agency business, literally, a guy calls in from a pension fund or a hedge fund and they want to buy an asset. They give the bank the order to buy the asset on their behalf.
and it's just executed in the market. And a commission is charged. And commissions are charged in basis points. And 100 basis points is 1%. So what's a typical commission these days? Anybody? What do you think? On an agency trade. Who said 5 basis points? Yeah, 4 or 5 basis points. Around a decade ago, the industry standard was about 20, 25 for agency business. So all things being constant in terms of volume in the markets, the agency business is down 80% in the last decade. That's one of the reasons why banks struggle. And this is totally risk-free stuff to the bank. The phone just rings, a salesperson takes the order, puts it in the system, and it goes through typically into an algorithm, and the algorithm executes it electronically. So there's very little human intervention. And that's pretty much 80% of all market-making business. So what does that tell you in terms of the time split of a trader at an investment bank? What does it tell you? What was the number in terms of time? They were spending 90% market making, yeah? And 80% of it's agency. So the vast majority of the time, they're actually just sitting at computers watching orders being executed in the market and just supervising them. That's the vast majority of what professional traders at investment banks do. It's pretty boring. But the perception is that it's totally the opposite. People think that trading floors are these huge hives of activity with lots of noise and everyone's shouting at each other. It's just completely the opposite now. Like you can walk onto the Goldman Sachs, Morgan Stanley, Bank of America, Merrill Lynch trading floor, and it's quieter than this room. That's what they're doing most of the time. So 2 things. Firstly, get it out your head that a trader's job is exciting. It's not. It's literally the opposite. It's really, really boring. And secondly, if you're a retail trader, the vast majority of what guys at investment banks do, if you're trying to emulate them, you're not emulating what they do the vast majority of the time. Because your objective is to make money using your own money, not execute client orders through an algorithm. But 20% of the market-making business is on risk. So instead of a client calling into the office, pension fund, hedge fund, and giving a risk-free order to the trader, which they just bung in an algorithm, the phone rings, and a salesperson picks it up, and the client asks for a price in the asset, and the market maker goes on risk to the client. What does that mean? They take the other side. So an example here, buying $10 million of Apple stock at $500. So 20,000 shares. What actually happens, the trader is short on the other side. So they're short $10 million of Apple stock at 500. If they buy it back above 500, they lose. So what does that actually mean? Well, it means the trading function in the risk model is to be the gatekeeper of the bank's balance sheet. So the trader uses the bank's balance sheet to attract business into the company. So if they lose $1 on that, they buy it back at 501, they're losing $20,000. Does that make sense? Now, if they're trading, they're not trading one stock at a time. Typically, a professional trader in an investment bank will be trading between 50 and 100 stocks at any one time. And what that is known as in the industry is a negative selection portfolio. You end up with 50 to 100 positions in stocks or the assets that you trade, which you don't even want. The reason why you're doing it is to bring business into the firm. So you get so the bank gets the commission. And where do those commissions get tagged? They get tagged on the sales desk. So the traders on the trading desk offer the bank's balance sheet to the world as liquidity. And then pension funds and hedge funds come in and use that balance sheet to trade. And then they get rewarded by doing big trades on risk, by getting nice, juicy, free agency orders to say thank you next week. Thank you for the week before, for going on risk to me in a situation where you knew you were probably going to lose money. And the ability of the market maker is really priced on their ability to keep the commission. And we call that a loss ratio or a retention ratio. So if $100 million comes in 1 year, and you manage to keep $80 million of it, which is a bloody good performance, your retention ratio is 80%, which means you're a shit hot market maker. So that's 80% of the time. 80% of the time agency, 20% risk. But it's 90% of the time. So only 10% of it is spent actually doing what's called, well, the polar opposite, trading proprietarily. As in, everything that the bank does proprietary to doing business with clients. That's why it's called proprietary trading. And it's the polar opposite. Because the traders are using the bank's balance sheet to do the opposite of a negative selection portfolio. So what they're trying to do is use the bank's balance sheet to make back the $20 million that they lost doing business. So the vast majority of the time is spent supervising algorithms. 10% spent managing a positive selection portfolio. And they're typically long-short portfolios. So they want to be longer stock, they want to be shorter stock, they build that portfolio and they run it. And typically it's a 1 to 3 month time horizon. And this is what a typical guy's business. So if you just walk up to a guy on a trading desk at an investment bank and say, what do you trade? The guy says, I'll trade the top 100 S&P 500 stocks for XYZ bank. This is what the business will probably look like in a typical fiscal year. Commission generated, 50 million, with a retention ratio of 70%. And then the same amount of commission coming in, roughly speaking, exposure in the proprietary trading account. Trying to make 20%. And then the net loss ratio. So you end up with a total revenue of 45 on a turnover of 50. Which is a pretty good performance. That's a decent year. The bank then gives that trader a discretionary bonus. So they just pull a number out of thin air. It's not fixed. It's just made up. So when you sign your contract to go and work for an investment bank, your contract literally says your bonus is at the discretion of the bank. And you have your bonus meetings leading into the day you'll get told, and then you get called in and get told. And that's the day that everybody in the year looks forward to, or dreads. Basic salary is paid, which is usually less than your bonus. If you're getting paid a bonus less than your basic salary, you shouldn't be working in the investment banking industry. And then an overhead cost, because it costs the bank $1 million for you to sit there. So total profit attributed to a trader might look something like that these days. In my day, it was double. So really, what have we learned here? Well, in emulating professional traders at an investment bank, you're not really trying to emulate at all what the professional trader does as a market maker. Your objective as a retail trader to make money with your own money is more aligned with their positive selection portfolio. So 90% of everything they do has got nothing to do with your interest, unless you want to go and work for a bank and become one of the guys that supervises electronic orders. But most importantly, or one of the most important things, you'll see that a trader in an investment bank has a basic salary. I'll make a statement and never, ever, ever forget it. Every single professional trader in the world has a basic salary. Every professional trader. If they don't, they're being legged over by the company that's hired them. And if they make no money in the proprietary trading account, they don't get a bonus. If they make money, they get a bonus. We'll come back to this later, the issue of a basic salary. So what does a professional trader at a hedge fund do? First things first, protect the capital of their investors by making money in markets that go up and markets that go down. But professional traders at hedge funds, usually called PMs, portfolio managers. Why? Pretty obvious, they manage portfolios. They don't go home at night with no positions, walk in the next day, get massively long a market, and then close out at 3 in the afternoon and go for drinks. They're running portfolios. They take overnight risk, and the time horizon can be anything from 1 to 18 months, usually. But it's usually 3, a 3-month time horizon. There's no market-making activity, but their function is extremely similar to the prop trading function at an investment bank, the positive selection portfolio. The only difference is the structure of the business that they operate in. Essentially, the trading, the way they do things, the processes they go through to choose what they want to buy and short are exactly the same. It's no coincidence why there's so many of the world's top hedge fund managers are ex-Goldman Sachs, ex-Morgan Stanley. They've all been prop traders at investment banks in the past. And then they've gone on to do the same function with outside investors' money, not the bank's money. The guys at investment banks are utilizing the bank's capital, so essentially that's shareholders' money, they're public companies. So let's go through some basics of a hedge fund. Well, why is it called a hedge fund? Because they use strategies that hedge out risk. So they can make money when the market goes up and down. But how is it structured? But it's just an investment vehicle for high net worth and institutions to invest in. And you have an onshore management company and an offshore holding company. And the management company charges a 1 to 2% management fee to manage the money, and an annual performance fee on the money they make using the capital in their positive selection portfolio. But what's very interesting about hedge funds is that when they go and pitch high net worth and institutions, as part of their pitch, and one of the conditions that investors have to invest in the fund is that in a given year, on the performance fee, at least half of the performance fee must be reinvested in the fund. No hedge fund charges a performance fee, takes their money and runs. They have to reinvest at least half of it. So let's have a look at a typical hedge fund structure, a hedge fund example of what might happen in a typical year. So let's say they're holding $100 million of investor money as assets under management, and they've got 50 positions, 25 long, 25 short. And they have a self-imposed position limit, so no position can be bigger than 2% in the portfolio. So nothing can be over $2 million. That's a very diverse hedge fund. They're not taking a great deal of risk. But let's say last year they made a 20% return on a portfolio with mid-teens volatility. That's a good hedge fund. If they're diverse that much, they make 20%, and they get and it's on mid-teens volatility, they're doing really well. They've had a good year. They charge a 2% management fee based on the AUM at the beginning of the year. So the onshore management company takes $2 million of fees and $4 million performance in that situation. But $2 million of that $4 million is reinvested. So what happens? It's pretty obvious. They don't get paid a performance fee if they lose money. They get the management fee. So first of all, what does the management fee actually do? What's it for? Anyone take a guess? Exactly. The onshore management fee goes to pay for all of the infrastructure of the fund, including basic salaries of everybody in the office. That's the first thing. All professional traders have a basic salary, and so do hedge fund managers. But what about the performance when they have a bad year? They don't get paid. In a good year, what do? They reinvest their money into the fund. So the fund grows. So what do retail traders have to do if they're trying to emulate successful hedge fund managers? Reinvest their money. So when they make money, they take more risk. When they lose money, they don't increase their exposure. It's pretty obvious, no? So why do retail traders do the total opposite? Huh?
They want to secure their profits.
Secure their profits?
They don't want to lose them again.
Yeah, so they're taking their money out of their trading account. That's a typical behavior, yeah? The holy grail for a hedge fund manager is to grow the fund, let's say from 100 million in year 1 to 5 billion in year 6. And a standard industry metric is applied to sell the hedge fund. There'll be a value to the fund because they've got 5 billion of assets under management. Does anybody know what it is? The standard industry metric for asset managers and hedge funds? It's 1/10 of assets under management. So they'll sell that fund for 500 million. And they'll have their own money in the fund the whole time and be increasing their holding the whole time. So they grow that from 100 to 5 billion and walk away with 500 million. That's a successful hedge fund manager. So you should really be taking a few messages from this. You know, if your objective here is to make money, which it is. No one goes into the market to lose money. We all go in with the idea that we're going to become superstars and make loads of money. So the objective here is to make money using our own money. So out of this, retail traders should take several really important messages. Hedge fund managers use their own money and accept outside investor money. Investment bank traders don't. So what does that mean? For a retail trader, your objective is a hell of a lot more aligned with that of a hedge fund manager. The prop function and hedge fund managers, they both hold long, short, diverse portfolios with a fairly medium-term to long-term time horizon, obviously depending on what company you work for and what the investment mandate is. They both get paid a basic salary. That's really important. So many retail traders think trading is for income. It isn't. People must have seen it before where you get the message, you get the emails. You can make $10,000 a month trading the international Forex markets. So people do it. They open a trading account, 100 grand. In month one, they make 10 grand. They take out the 10 grand. They spend it. In month two, they lose 10 grand. Then they take 10 grand out, and they're left with 80, and they spend 10 grand. So what are they doing? When they make money, they're taking money out of their trading account. When they lose money, they're taking more risk. They're doing the total opposite to what professional traders do. You should never, ever, ever, as a retail trader, take an income from your trading account. It's not an income strategy. If you want an income strategy, buy a bunch of stocks and hold them for a decade that pay a 4% dividend yield. Go and buy a flat and rent it out to somebody. That'll pay you an income. Go and buy a government bond. That'll pay you a coupon. Trading is not for income. Every professional trader knows that. That's why they charge a management fee, so they can get paid a basic salary. And the industry is very, very competitive. It's so competitive in the hedge fund industry, people going and pitching high net worth institutions for a limited amount of capital. It's so competitive that all of them still ask for a management fee. So why do we think they do that? Because they know that trading is not for income. Their objective is to grow their account to as big as possible so they can sell the fund. So they don't want to take any money out of the fund. They want to reinvest it as much as they can because they want an exit for as big as possible, as quickly as possible. Does that make sense? So hedge fund managers are literally doing the total opposite to what most retail traders do. When they make money, reinvest. Lose money, don't increase your risk. So let's go through some of the main differences. We have touched on some of them already. Differences between professional traders and retail traders. So if you're going to compare yourself or try to emulate the best and most successful professional traders, you've got to emulate their strategies. And from a very basic level, we've been through some of them. You've got to have a basic salary doing something else to begin with. Otherwise, you're just not going to grow your account because you'll be forced to take an income from your trading account. And it'll be terminal. You'll just go to zero, either very quickly or slowly. But you will be at zero at some point if you do that. And the principle of taking more risk when you make money and taking less risk when you lose money. From the ground up, that's pretty basic stuff, but millions of people get it wrong every year. And it's repeat and rinse. Every year, same approach, go to zero, start again. Put 10 grand in your trading account, lose it, go to zero. 6 months later, start again with another 10 grand, do it again. No one ever learns. But the problem is due to all the misinformation and conflict of interest that exists in the industry, this is why people behave like that. So we've touched on one of them already, which is pretty obvious. What a professional trader actually does. You'll get tons of people in the industry who have got the conflict of interest showing you or trying to convince you that professional traders approach the markets in a particular way when they actually don't. And that person who's telling you that has never been a professional trader. So how would they know? There's a lot of misinformation, and the misinformation is due to a conflict of interest. So what is the difference? What are the approach differences? So hedge fund manager, investment bank, professional trader with a positive selection portfolio. Long-short portfolio, 1 to 3 months. Retail trader, the approach is typically directional day trading around binary situations. What's the approach to risk? Diversity and risk management. The job of the hedge fund manager and even the guy at the investment bank in the prop trading function, their job first and foremost is to protect that money and then seek to grow it. So by first protecting it, what's required? Real diversity and proper risk management. All you'll hear talked about on a desk at an investment bank or at a hedge fund is the risk. What's the risk here? Are you on top of your risk? What can we make or lose in one day? With the retail trader, risk is extremely concentrated. So concentrated, when a professional trader looks at a retail trader's trading book, they can't understand why somebody would only have 2 or 3 or 4 positions. It's lunacy. They look at it and they just can't understand why. So someone might be long the S&P 500, might have a long euro US dollar position and short a dollar yen position. But also you've got no diversity. You're just going to be up or down on the day, and your book is out of control. You can't control what's going to happen. So professional traders will just never, ever do that. What's the approach to return? Professional traders are seeking long-term consistent returns. We know that because the objective of the hedge fund manager is to get AUM, assets under management. No one's going to invest in the hedge fund or that trader if they're up 10% one month, down 10% the next month, and they just never make money. You want consistent returns, smoothed over time, which show a strong track record, and behavior in good times and bad times in the portfolio, where people recognize you do the right thing in good and bad times. So you show good behavior in your track record. So when you make money, you know you're making money and you increase your risk. And when you lose money, you do the right things to reduce risk. And if you show that over a number of years with smooth returns, you're going to have a much easier job pitching somebody for 100 million to invest in your hedge fund than if you're just all over the place. Retail trader, polar opposite. A good month, up massively. A bad month, loses all their money. Or half the money. What's the outcome? For the professional trader, it's all about capital preservation and growth. Sell the fund or get higher fees or bigger bonuses. 2% on 5 billion is a lot of money. What's the outcome for a retail trader? Just capital destruction. Assets go to zero. Try again next year. Professional trader, what's the approach to income? Ensure your minimum standard of living by making sure you have a basic salary. Retail trader, working full or part-time in a normal day job, but they trade for extra income. Which means if you open your account with $100,000, even if you're good, in 10 years' time, you'll still have $100,000 because you're taking a salary. In terms of growth, professional traders will add when winning and reduce risk when losing. What happens to the retail trader? Take income when winning and seek risk when losing. So taking more risk. What's the result? Hedge fund managers will grow their assets under management. Retail trader, trading account goes to zero. Outcome, the same as before. So here's the differences on one page. Expectations management. All professional traders aim to get rich slowly. Compound returns. All professional traders seek consistent, smoothed, risk-adjusted returns, compounded. So let's do a bit of compound math. If you open a trading account with £10,000 in year one, and you use that £10,000 to enable you to take £40,000 worth of exposure, if you get a 25% return each year, so call it 2% a month on average, smoothed over time, there will be months where you lose, but if you make an average of 2% a month, in what year does your account become $1 million? Anyone know? Has anyone ever done it in a spreadsheet? Worked it out? The eighth wonder of the world, compounding. Einstein did actually call it the eighth wonder of the world. It's about 2/3 of the way through year 7. So you can grow £10,000 at 2% a month on average to over $1 million by the end of year 7. If you just keep reinvesting and never taking an income. But one thing's guaranteed, if you take an income of £2,000 a month, you'll still be at 10. Or you'll be at 0. So you've got two choices. You either do it that way, the professional trader way, the real way, or you do it the retail trader way and just never, ever, ever become wealthier. I don't think we need to go over this one again. No income from trading. Retail traders want to take income. Professional traders don't. They ensure their basic salaries. So they make sure they get their minimum living standards from making a basic salary. So to recap, and we know what the differences are, the majority of retail traders just lose money because they do the opposite of what all successful professional traders do in all ways. Approach, risk, income, everything. Everything's the opposite.
Okay, so welcome back. That was professional traders and retail traders. And I guess, what have we learned here? Well, I think what we've learned here in terms of what professional traders actually are is that there is a very big misguided perception or misinterpretation of what professional traders are and what they actually do. I think in the retail trading community, we need to clarify quite a few things in terms of the professional traders' objectives. Because essentially as retail traders, you're trading with your own money and you're trying to emulate the successful professional traders and trying to make money with your own money. Well, it seems like we can forget about guys at investment banks. The only thing to take away from guys at investment banks is that they have a basic salary. The rest of the stuff they do, it's just not in the same objective as the retail trader. Investment banks are trading with the bank's money when they're doing proprietary trading, as in all business within the bank that's proprietary to doing business with clients. The vast majority of the time, and we're talking 80–90% of the time, of a professional trader at an investment bank, they are trading with clients, so either on behalf of the client or they're trading on the other side of the client and taking risk using the bank's money on the other side. Nothing a retail trader does is in any way similar. So these guys, in terms of their 80–90% of their day-to-day activities, retail traders, you just don't need to think about it. The only thing that they do which is similar is proprietary trading, which is using the bank's money to make back the losses from doing client business. In their approach in terms of prop trading, that's what we're interested in, because that approach is very similar to hedge fund managers. It's no coincidence that most hedge fund managers originally start off at investment banks. The proprietary trading function of a guy in an investment bank is very similar to the approach of a hedge fund manager. But remember one thing, the guy in the investment bank, 80–90% of what they do is irrelevant for retail traders. And the second thing, they get a basic salary. Hedge fund managers, different, in that they have their own money in the fund. Very similar to retail traders in their objectives, because a hedge fund manager wants to create wealth, but doing it in a very different way. A very different way to the way retail traders would expect. Firstly, they're charging a management fee. So they put their own money in their fund and they accept outside investors' money and they charge a management fee. Some would say the reason why they accept outside investors' money is so they can charge a management fee so they can get a basic salary. The management fee pays for all of the infrastructure and basic salaries of the office and the people at the hedge fund. Typically, a basic salary would, management fee would be 1 to 2% on assets under management, AUM. And then on top of that, they're charging a performance fee. Typically, a performance fee would be 20% of any money made for outside investors. So what have we got here? We've got a basic salary which protects the downside wealth of the hedge fund manager. It protects their downside. So it protects the hedge fund manager from becoming poorer. What have we got on the upside? We've got the performance fee, where the hedge fund manager charges the performance fee, typically 20%, to become wealthier. Now, how do they actually become wealthier? Well, what they do is they have contracts with their outside investors, and typically their outside investors will make the manager contract to putting at least half the management fee back in, half the performance fee, half the performance fee back into the hedge fund, back into the strategy. So what does that mean? Well, let's go through an example where a hedge fund manager charges 2% management fee and 20% performance fee. And let's say, for example, it's your money. Well, if you put in 100 and it becomes 120, in 1 year, so let's say that's 100 million US dollars, and the hedge fund manager makes $20 million in 1 year. Well, if the hedge fund manager came to you and said, I'm going to charge you a 20% performance fee, $4 million, and I'm going to take all of that money and just not reinvest in the fund, well, you're not going to be very happy. You're not going to be happy because it gives you the message that the hedge fund manager is not willing to invest in their own strategy. That defeats the whole purpose. The whole purpose here is that everybody becomes wealthier together, and that the hedge fund manager's winning strategy is so good that outside investors want to invest in it. Therefore, if it's so good, why is the person not investing in their own strategy? Well, it doesn't make any sense. So typically what will happen is they'll be contracted to invest at least half of the performance fee back into the fund. So out of that $4 million, $2 million will be reinvested. Now what happens if the hedge fund manager doesn't make money? So the 100 million stays at 100 million. Well, it's pretty obvious. There's no performance fee, therefore there's no reinvestment of the performance fee. So what do hedge fund managers do? They invest in themselves and increase their trading accounts, because a hedge fund, essentially, if you look at it in that way, it is a trading account. They invest in themselves when they're making money, and they don't invest when they're not making money. And the objective is obviously to make money every year, but every year, if they're making money, to increase their assets under management. What does this mean for retail traders? Simple. You don't take income from your trading account, you grow your trading account over your lifetime until retirement. Now, think of the opposite situation, where if you're a retail trader, and this is a very typical situation in the retail trading community, the vast majority of retail traders are under the impression that trading is, for some reason, for income. Whether it's they're going to do it full-time, or what most people do is they try to trade and they try to supplement their salary by taking a monthly income from their trading account. So let's think of this in round numbers again. Let's say you put $100,000 in your trading account, and you have the impression that you're going to make $10,000 a month trading the Forex markets, and you're going to take out $10,000 a month in income to supplement your salary doing something else. So you open your account, and after month one, you're up $10,000. What's the next thing you do? Well, you need to pay yourself $10,000. So you take $10,000 out of your account. What happens? Your capital is back to $100,000. Now, if you go and spend that $10,000, you're no wealthier. So there's no point. Now, what happens if you then in month two lose $10,000, but you're relying on your trading account to pay you a salary of $10,000? Well, that just means you're going to take $10,000 out of your account. You're going to go from 100 to 80. Now, to maintain the same levels of exposure, you're going to have to take more risk to get the same return that you had previously. So all that you're doing is the opposite of what a professional trader does. A professional trader doesn't take money out when they're winning and doesn't put money in when they're losing. But they don't take more risk either. So what you're actually doing is the opposite. When you make $10,000, you're taking it out as income, and when you lose, you're taking income again, which means you're taking more risk to maintain the same levels of exposure. Now, if you're going to invest in a hedge fund, I'd bet if you were going to put your life savings in a hedge fund, you would want to see consistency of returns, you would want to see diversity in risk management, you would want to see responsibility, and the consistency that they get, the consistency comes over a long period of time. Now, if you put your money in that fund what's probably the most important thing out of everything, probably the most important thing is that the manager themselves invests when they're winning. When they're actually making money, they don't take it out of the fund. They put it back in the fund. That's not going to sit with you very well if the hedge fund manager charges you a performance fee and takes their money out. It just means you're sponsoring the hedge fund manager to become wealthier, but they're not investing in their own strategy to become even more wealthier. So it doesn't make any sense. It defeats the whole purpose. So, a couple of things here. First, basic salaries. Don't be under the impression that you're going to, for some reason, leave your job. You're going to trade with your own money, and you're going to take a salary from your trading account. Because the only thing that's going to happen, if on a monthly basis you take money out when you're winning and you take more risk when you're losing, the only thing that can happen over time is that your trading account goes to zero. Secondly, the approach. The approach has to be one of consistency, diversity of risk management, and reinvestment of your money when you're winning, and taking no further risk when you're losing or not making money. Now, this situation of going to zero, let's discuss this a little bit further. What happens if you're in this situation where every time you make money, you take money out of your trading account, and every time you lose money, you take more risk? Well, you're going to zero over time. It just depends how long. What happens if you leverage this situation? So we now borrow $1 million to reinvest in the same strategy, but we use the $100,000 as collateral to borrow the $1 million to invest in this strategy. Well, it just means your $100,000 used as collateral to cover losses against the $1 million is going to go to zero quicker, because you're going to have to pay those liabilities. And this is what happens in every trading account that we call a margin account. Margin is just money that's deposited in your trading account, and it's used as collateral to enable you to borrow through the brokerage company 10 times typically in stocks and indices, and 100 times in Forex. And if you do that, all that's going to happen if you leverage this strategy is you're going to go to zero quicker. It's the only thing that can happen. You take money out when you're winning, you take more risk when you're losing. The outcome is terminal. Your account tends towards zero and goes towards zero quicker. So you just shouldn't do it. And you'll end up getting what we call a margin call, where the broker literally gives you a call, a telephone call, and sends you an email and says you have to put more money in your trading account to cover the losses in your account. If you don't do that, you're wiped out. So let's summarize here before we move on. If you're going to use your own money to trade, be under no illusion, professional traders all have basic salaries. You should have a basic salary as well. You should maintain this basic salary. You should trade to begin with as a hobby. When you get good at trading, at some point in the future, it may become a viable option that it becomes a profession. But as it stands, if you're working, you've got a basic salary and you're not a professional trader, you're a retail trader, maintain your basic salary and protect your downside wealth. That's the first thing. Secondly, your account, your capital. Do not take income from your trading account when you're winning. Do not take more risk when you're losing. You should view your trading account as an asset in itself, and the asset, you're aiming to increase the value of this asset over your lifetime between now and retirement, or even the day you die. That asset sits on your balance sheet as a human being, and the value of that asset is completely linked to your ability as a trader. So if you're good, you increase the value of your account, and you have an option to put more money into your trading account and keep increasing the size of your account. If you're bad, you don't reinvest in that strategy. You just try to get better, and when you get better, then you have the option to invest more money. It's very straightforward, but many people make the mistake because of misinformation in the market and in a big bad world that professional traders take income from their trading account. Professional traders have concentrated risk. They take big risks. They're running around screaming at lots of people. They've got hundreds of computer screens. It just doesn't work like that at all. In fact, most of the things that you probably think a professional trader does, they're probably the total opposite of what you would expect in reality. And in reality, from a professional trader's perspective, I can tell you they absolutely are the opposite of what you would expect. So just take those things on board. Make sure you know them. Now that you know what a professional trader does, you can move on to understanding what successful professional traders do, as in the guys who have got the same objectives as us, the hedge fund managers that trade with their own money, trying to become wealthier using their own money as capital. That's what we're going to move on to now. In video number 2, I'll see you in clip 2.